My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. Today, zooming in from Boston, Massachusetts, we have a very interesting gentleman, Andrew Schena, who has gone from being a flipper into being a real estate developer. So we're going to talk today about flipping into development deals. So Andrew, welcome to the call. Great to have you.
It's a pleasure to be here. Thank you so much for having me, Dave.
Give us a little snapshot of what you're up to with real estate these days. What do you focus on primarily?
So primarily we have our main focus for the past 5 years has truly been urban infill multifamily development in the city of Boston.
Our multifamily, what size properties typically?
Anything ground up, it's usually 5 or 6 is the size. I mean that, from a dollar perspective and size, I mean, we're kind of limited on the size of the buildings that we can do in some of the neighborhoods of Boston, which has pretty restrictive zoning. We're not the size of developers that are out doing 100, 200 unit buildings like institutional.
But I think a lot of people could relate to 5 or 6 units. Like that's within their concept, especially going from flipping into doing these kind of development type deals. So
absolutely.
Tell us a little bit about your story, because you started off in flipping, and then when did you flip the switch into development, ground up development?
That's a great question. So we started primarily focusing solely on ground up development in about 2018, 17, 18.
Okay.
And the story behind that was because as we were churning through flips, a lot of our flips in the city of Boston were full gut renovations because the age of the housing stock is just so old that it, when you do a fluff and buff, if you will, just a real light cosmetic rehab, as somebody who cares about the types of places that they develop or redevelop, you always had an eye on things that weren't just quite right. Sometimes you still have that charm in the floors that you could roll a quarter across and from front to back, and there's just slopes, and so things weren't great. And the other difficulty with some of the flips that we were doing were once you start, I refer to them as flips as like an onion, because the more you peel back a layer, the more they make you cry, because the cost just keeps cycling up.
Oh, and I can only imagine with those historical type properties, some of them, you probably weren't allowed to tear the sucker down, even though that's exactly what it needed.
Well, so correct. I mean, in our past, some of our buildings, with our inexperience, we did want to save an older building, and we should have just torn it down. Okay. But many of the projects we work on, they're not necessarily historical, but we definitely try and stay away from those because they are a lot more of a headache and much more specialized and a lot more oversight, and that's
no, that's crazy.
But so knowing that, and the development, moving into full to ground up new construction, it really started with becoming more familiar with the entitlement process. And that's truly where you create all of your value.
Okay, so walk me through that, because
sure,
there's a skill set involved with being a successful flipper. And I'm sure a lot of flippers think, well, how hard would it be to get into ground up development? But I'm sure it's a completely different kettle of fish.
Well, honestly, it's like if you look at a development project from entitlement to construction, and then either sale or lease, a flipper it's very similar from the construction to sale or lease side. The only difference is the new piece, which is the entitlement. Okay. So truly becoming familiar with whatever municipality you're building in, what their zoning laws are, how to go through that process, hiring the engineers, and really trying to understand what, for lack of a better term, what box you can put on said lot. And within the neighborhood, and making sure that the structure is architecturally similar to other things that are within the neighborhood. And with it's depending on where you're actually building. So Boston specifically, a lot of the neighborhoods have a lot of say about what you can and can't do there. A lot of people don't like change. But a lot of these neighborhoods, exactly.
Especially in old historical neighborhoods. So So I've interviewed a number of people that are kind of in this line of work, Andrew, and it's really interesting because, like you say, the entitlement piece is what's really different.
Yeah,
And there are so many, from what I understand, opportunities to profit before you even put the shovels in the ground
yeah,
necessarily, right? So the
absolutely.
whole idea of taking a single family home and knowing well, maybe getting that lot rezoned for multifamily,
Mhm.
whether you do anything or not to the property, bang, just that rezoning has increased the value phenomenally, correct?
Absolutely. So what we generally tend to see and what we love about it, the process can be difficult with, having challenging discussions about what you want to build within a
Dealing with
neighborhood.
bureaucracies as well. Yeah.
That as well.
Yeah.
But once something is, we usually go through the zoning board of appeals. That's what it's called in Boston. It's different in every kind of town, city town.
Yeah.
So once you have a ZBA approved project, and you've increased, so you've already given the land value a lift, from, generally speaking, hopefully what you bought it for to now what its value is if you've increased density. Other lots, like if it's out in the suburbs, if you're taking a piece of farmland or a large parcel in the suburbs and you carve that into 30 home lots, you've increased the value of that by increasing the density of it. So
Yeah.
you can capture that value by selling the ZBA approved project. So that's one exit opportunity. The second, so if you're doing a multifamily, the second step is then to go through and get the whole building fully permitted.
The
So
permits. Yeah.
right. So you supply all of your engineering and your construction docs set, and you have an approved building plan that is approved, obviously approved by the municipality. You can then turn around and sell it for a little bit more of a premium because now you've spent all the money to engineer it and the
Well,
time,
I would imagine quite a bit more of a premium, I would hope. Because
depending on the
that's
size
a
of the
lot,
building.
I
Absolutely.
guess. Yeah. Yeah.
Absolutely.
Yeah.
Right.
Yeah.
So, or you can decide to go through and build it. And then you're going to now get a more of a premium because now you have a finished product. If you're
Mhm.
going to sell it, or if you're going to lease it and sell it down the line, or just so those are all of your exit strategies. So
Yeah.
going through the development side of the business, you open yourself up to multiple exit strategies depending on the ebbs and flow of your own business in the market.
Yeah. Yeah. Very cool. So were you aware of this before you got into it, or is this kind of a pleasant surprise once you got into this side of the business?
No, it was not something not something I ever technically said I want to go off and do ground up construction.
Yeah.
We started doing gut renovation, three families, turning them into three condos in South Boston specifically back in 2011. Our first ground up project wasn't until 2013, 14. So it took us a couple of years to really get our construction and understanding our syndication structures. And back then, not a lot of people knew what syndication was. I know I didn't
Yeah. Yeah.
until
Yeah.
I actually went and understood it and understood how to properly raise capital. And once we started doing that, and we made so many mistakes on our first building. But you just get better with time. And
Yeah.
after that first one, we did very well on it. We went back to just doing what we were comfortable with doing, and then by 2018, we said, look, like we have better control. We produce a better product. We can create more value and control our exit strategies by going and doing ground up development. So that's the reason why we've
So
primarily
did you guys pivot completely away from flipping and just focus completely on ground up
as a team,
development?
yes,
Yeah.
because I mean, we will do. I mean, if there's a great project that comes across our desks and it makes sense, we'll do it. Absolutely,
Mhm.
like we've got the skill sets to do it. But primarily, a lot of our focus over the last 7 years or six and a half years has been ground up construction.
Yeah, because I would imagine that one of the challenges for a flipper switching gears and going kind of all in with this is it can take a long time to get those approvals, to get that
Yeah,
rezoning, to get those permits, and a flipper, especially if they're into volume, they really need that
truth.
consistent deal flow and stuff going on because that's what keeps the lights on. So how do you kind
Absolutely.
of make that transition, or do you kind of wean yourself out of
You,
the
you, you,
flipping?
we, what we've found is that we've weaned ourselves off by structuring our deals a little bit differently. So
Okay.
we raise a lot of private capital. It's not all our own. to do our deals. And what we have learned is that, like, if you're willing to kind of provide a better structure and a better return to your investors, risk appropriate return to your investors are okay if you're taking maybe some fees up front,
Okay.
but you're giving a little bit more on the back.
So more of an equity play for them versus just a simple return on investment. Is that what I'm
That's
understanding?
correct. That's
Yeah.
correct. So we would structure, all of our investors generally come in, because what we found, we started with our friends and family, and then went a couple circles out. And
Yeah.
when we started talking to people, our investors were they were comfortable with the fact that, of investing into these syndications, but they wanted something tangible for their investment. They didn't want to be an unsecured debt investment.
Hmm.
They wanted some security that actually held the asset within the LLC. So we were okay with that, and we've structured many different types of deals. We have taken equity investments and treated it like debt, where when the market has been a little bit shaky and we're not sure how the equity performance is going to be, but we'll say, look, we'll reduce your risk and say we'll tie you directly to a debt instrument, having an equity slice, so you have something to hold on to there,
Kind of the best
rather
of both
than
worlds.
exposing
Yeah.
you to a full equity
Yeah.
payment.
So you got the option there where you can kind of treat your LPs almost like joint venture partners a little bit.
That's correct.
Yeah.
Absolutely.
Smart, smart, smart. So for you guys, is the primary exit strategy long-term buy and hold of these properties, or are you turning around and selling them to somebody else?
Yeah, great question. So we generally do what our market, we generally provide what our market demands the most of, and that's condos.
Okay. Yeah.
So yeah, generally everything that we build is a for sale product, to the marketplace. And to be quite honest with you, I would love, and we as a team would love to develop and hold things. Our capital base, in order to do that, when you finish one of these buildings, the returns are not commensurate with the amount of time people want to have their money out.
Right.
So what we find is, like, if we finish a building, by the time we load it up with tenants, it would end up being like a levered 5%, 4% return. And it's just not enough
Not
juice to
sexy enough.
squeeze. Right.
Not sexy enough, even though they understand that moving ahead, their returns are going to keep coming in year after year after year after year, plus tax benefits, plus all that other stuff,
That's
right?
right.
Maybe
So,
you got,
a lot of our investors, they want to be in and out. Our average project is about 2 to 3 years.
oh, it's pretty fast. Yeah.
Yep. So, but the entitlement takes about a year. The
Hmm.
construction takes about a year, and then the sales process could, depending on the size of the building, could take anywhere from 2 to 6 months.
Yeah.
So it's a bit of a cycle. So, a lot of our investors they're not 10, it's not 10-year money. Like,
Yeah.
people aren't in it to say,
Yeah. Plus,
hey,
they're probably not seeing a return on that until you cash them out, right? So, I
that's
mean, it's
correct.
kind of
That's correct.
stagnant money for a while. Yeah.
So we could produce a much bigger return over, let's say, a 7-year period.
Hmm.
But a lot of these people just want to get in and out, and that's where our expertise has been.
Hmm.
And that's, we're in the development and sales business.
Well, cool. But are you wanting to get into the development
Uh,
and the whole
of,
business?
I would
Yeah.
love to.
Yeah.
Absolutely
So it's
love
just
to.
a matter of finding,
The
maybe doing
right
a little bit
deals.
of combination of both
That's right.
and figuring out a way to cash out the first guys and bring in some second guys, or just find some new guys that are comfortable with a longer term
Absolutely. And
hold. Very
we
cool.
over time, over the duration that we've been in business, because we want to hold assets, we've been able to take, the earnings that we make off of a condo building and go out and actually find some existing cash flowing buildings that we might be able to do a value add on, and just hold it for our own personal portfolios, and just kind of rinse, wash, and repeat that.
Yeah, that's smart. I have heard of a few other guys doing something similar to you, and then let's say they build 6 or 7 condos,
Mhm.
they sell off 6 and keep one.
So that's actually
Yeah.
funny you say that, because the building that we're currently exiting right now, we have 2 units left. And once the last one is gone, our intent is, like, the building will be free and clear. So our intent is to, capture whatever small amount of short-term gain, we can, but then the rest of it will be locked up, and we'll do a cash out refinance of that last unit, take that money tax free, park tenants in there for a couple of years, and then sell it with either if we sell it at a lower long-term capital gain, or we 1031 it and then start rolling up in asset size.
Very smart. Andrew, we're early days in 2025. What are your aspirations and goals for the business this year?
So goals of the business this year are to continue to execute within our market. We actually have a 6-unit we just submitted on, and I've been negotiating for 2 days on a parcel that I've literally had tabs on for the last decade. And I'm unfortunately right now, I feel like I'm overpaying for it, but I know it. And although we think we're going to overpay for it a little bit, the profit margins are on the lower side of our minimum. Like, so we have our minimum, so it's just above that, but we know the street. That's where the project we're selling right now is. And it's just, it's comfortable. We know it.
Backyard.
We're okay with it.
Yeah.
We'd also like to start kind of taking a look at some shallow bay industrial. We've flirted with some industrial in the past. And so we want to kind of start looking at that. We're starting to look outside of the city of Boston. And I'm currently looking at like a 30-acre parcel in the town that I live in, whether it's zoned industrial. So if we could do maybe a couple of smaller industrial buildings, pivot into a different asset class while continuing to do our urban infill multifamily condo work. But that, depending on what may happen with that and price point, things like that, it's 30 acres. You still might be able to actually put in housing or maybe do an assisted living facility. So to kind of expand and broaden the asset class that we can kind of do, because what's great about the development space and the multifamily space is once you are familiar with the construction, the entitlement and the construction piece of it, you can apply the same thing through different asset classes. As long as you understand the nuances within the specific industry or asset class that you're looking to build. But you bring in people within a team. And that's the biggest part about development, is surrounding yourself with the right team, the engineering team, the sales team, and the town, the residents and the politicians within that municipality. As long as everybody's understanding and knows and is on board, everyone collaborates together. It's a joint effort in the development space. So we try to mitigate as much risk as possible, and that's part of it. So jumping into a different asset class, that's part of it.
Andrew, if people would like to connect with you and find out more about what you're up to, where should they go?
Absolutely. They can go to LinkedIn. They can find me there, Andrew Schena, Schena. You can also email me. I'll spell out the email. It's a little long, but it's A Schena, Schena at CAP, CAP as in Peter, Equity Partners with an S.com.
And that website's probably good.
The website is the same.
Well.
Yeah. Thank you. CapEquityPartners.com.
Awesome. Well, thanks very much for being on the show. That was great.
Absolutely, Dave. It's been a pleasure, and thank you for having me.
All right, everybody, take care, and we'll see you on the next episode. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now, at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.